Okay,
Yeah,
well,
I will let you know I had a client one time say, "Thank God you know taxes, Holly, because you do not know IT." I couldn't. So this was just proof again. I'm 0 for 0 for 2, I think here. Um, anyway, I appreciate your time today, ladies, and I was going to talk a little bit about what's called the one big beautiful bill of that happened back in July. It was the one big beautiful bill act of 2025. And I call it the O Triple B, so you might hear me call it that. There is no consensus. The name was just entirely too long. Last week I went to a an educational seminar and they called it the OBBB, and I thought that was even dumber sounding. So we'll go with O Triple B. Um, it covers a lot of things. If you want to go to the next slide, covers a lot. I thought we'd start with some silly trivia. I threw some in the middle because it can get kind of dry. We in the United States eat 350 pieces of pizza a second. So that's 100 acres of pizza every day. If you want to go on, next slide. Um, just thought I'd talk about a little bit in big picture. Have you ever asked yourself why you don't know more about taxes? And if you go to the next slide, I think this is why. This is just a snapshot of some of the tax law that happened over a 7 year period. Eight big pieces of tax legislation in 7 years. And why don't we know taxes? Well, probably some of this. The O Triple B came out. It's got so many working pieces, and tax is just a part of it, but it affects our lives every day. And all of this comes out constantly. We're bombarded with it. So I thought what I would do today is kind of hit some of the big pieces that individuals might see on their daily basis. So there's a lot that have to do with businesses, and I wasn't going to cover that today because it might affect you, it might not. I thought we would go over more individual stuff. Next slide, and you can go on. This I'm not going to go through. I will leave it with Jen too. Anybody is welcome to the slide deck. Just wanted to point out today that one of the biggest things that changed from what was called the Tax Cuts and Job Act, that was the first, President Trump's first time in office, and they lowered the tax brackets. There used to be less of them, and you got through them faster. So one of the things that did change and will now stay with the O Triple B, it's made permanent, is that there are more of them, and it takes you a while before you get through it. So the average American is in about the 22, and it's actually between 19% and 22%, which used to be several percentages higher. So this did make everybody's taxes a little bit lower. Okay. There was also, and this I liked, a permanent extension of the increased standard deduction. So there's two things. You have your standard deduction, which the government just says you don't have to prove anything. You just get to write this off. And then there's itemized deductions, and that's for folks that have mortgage interest or particularly charitable people or something where it's even more than this. But in 2025, a married filing joint couple will have $31,500 deduction against their income without having to prove anything to the IRS. So, um, I mean, that's a good amount. So if you make 100,000, you're really only immediately going to have, be taxed right away on 68.5. If you're over 65 or if you are blind, if anyone's blind, those are an additional $2,000 each. Through an example in here, a married couple, they're both over 60, they're both over 65, they're 67 years old. Their standard deduction would be the 31.5 plus 2,000 plus 2,000 because each of them are older. So they have a standard deduction of 35.5. If one of them was blind, their standard deduction would be 37.5. So these are all just amounts that you fill out the form and it calculates for you without you having, if you came under audit, there'd be no reason. They wouldn't have anything to look at. One of the things they did make sure that permanent repeal was personal exemptions. Quite frankly, a lot of people didn't get these. That's it with this child tax credits being so much higher. It used to be where we cared, like, oh, I've got a couple of kids in high school, I get this like $2,000 write down on each of the kids. Now it's generally these child tax credits that have taken over and the exemptions are gone. Okay. And then there's a new deduction for seniors. So personal exemptions, what else did they include? It was anybody. So you would start with a lower standard deduction or your itemized deduction, and then there were some exemptions lopped on to the top of them. That's what the exemptions were. So it was just another sort of standard deduction for your family. That's gone, and in lieu of that is these much higher standard deductions in general. So that's why the exemptions are gone. If that didn't answer the question, let me know. So now seniors will also have an additional deduction. So they have $6,000 additional per person. So $12,000 for a married couple that are over 65 or 65 and over. So 65 years older, it doesn't have to be 66, they can be 65. You cannot claim this if it's married filing separate, but you can for anyone else, single or married filing joint. And it does phase out for taxpayers. Now it's a modified adjusted gross income over 75. And the difference is they add back things that might not be taxable. So adjusted gross income is anything, or taxable income is really anything that shows up that interest, dividends, your IRA stuff, your Social Security. But modified adds back things like something that otherwise wouldn't have been taxable, like non-taxable interest. So if you've got somebody, say you've got an older married couple that maybe has bonds and they're kicking off non-taxable interest or non-taxable dividends, that gets added back to this phase out. Also, Social Security is generally only a percentage of it is taxed. So if someone brings home $30,000 of Social Security, depending on what everything else income wise is, they may only be taxed on 18,000 of it. Because you don't get taxed on the whole thing. The most is only 85% of what those Social Security people have earned. So 15% of Social Security is never touched, really. But for this purpose, they add it back to the calculation so that if somebody generally, I think what they're thinking is if somebody is wealthy, they've got a lot of non-taxable stuff, and their Social Security is a higher amount, we add all that in to see if it's either 75 or 150,000 for a joint filer before they get the $6,000 write-out. If they do qualify, it's literally just another deduction, just $6,000 off of all the income. So that is a help for most seniors. Next slide.
Is the additional standard deduction, the 2,000 or 1,600, that's not a subject to phase out, right? Just this one is subject to phase out?
Just this one. Yeah.
Okay.
This is only available for these 3 years, 25 or 4 years, 25, 26, 27, and 28, at least for now. I think you probably working at Trilogy, Karen, you probably have seen this too. I think they're going to have a real tough time taking this back from seniors in 29. So I feel like this is one that once they got it in, probably managed to get it in over some objection somewhere by putting a time limit on it. But I feel like this is now a thing that we'll see. But yeah, it phases, but not that additional 2,000. Or the standard is for anybody. Okay. Okay. We all had some more permanent things that were done. So one of the things that I know that happened with the OBBB was that the Tax Cuts and Job Act, that one happened in Tax Cuts and Job Act of 2017. So that one happened in 2017. And that was a big piece of tax legislation. We're still really trying to make sure that we understand that one. What the OBBB did was just extend a lot of that. So one of the things that happened was the home equity interest deduction was suspended, and now it's permanently suspended, which means you used to be able to borrow money to fix up your house a little bit and deduct that interest, and that interest is no longer tax deductible. Also on the mortgage, the original acquisition indebtedness, meaning you buy a house for $500,000 and you have a mortgage for $500,000. The mortgage, all of that interest is deductible on your tax return. If you buy a home for $1 million, or that's what that mortgage is for $1 million, only 75% of it, or the part that you can attribute to $750,000, is deductible. Mortgage insurance premiums, which is probably what affects more people than this phase out, those have come back and they are restored as a deduction. They were taken away and they're brought back.
Did this just restart on your screen?
It just showed it didn't show it. Now it's just showing your email and not the
Okay.
thing.
Weird.
I'm not going to complain after what I did.
Okay. No momento. For some reason, it just glitched out on me. Okay. What happened? Where is it? I'm sorry, guys. I don't know what.
That's okay. One thing I can comment on while we're waiting, when we're talking about home mortgage interest, one thing that I want to point out, especially to folks that are members of G.R.I.T like this, you're doing a lot of different things. You might be borrowing money maybe to start a business, or to put it into an investment or do something like that. If that's the case, that interest is deductible in a different way. Um, you can deduct that interest as investment interest expense. There you go. And you can deduct it against, if you have, say you have a partnership and you had to borrow money from the bank to put into the partnership, that interest is deductible directly against your partnership income. So you're not stuck in that. Say you don't even itemize, say you use a standard deduction. You don't have to lose that mortgage interest or something that you borrowed. If you use it for investing or putting into a business, that's deductible in a different spot on your return. So keep in mind, you can always kind of tap that. The casualty loss deduction has permanently changed as well. So what you used to be able to do, if somebody stole something, it was, it had to be higher than 10% of your adjusted gross income, but you could deduct that on your tax return if you had some casualty, something happened. Big storm and a tree went through your roof and it cost you, and you don't get it you don't get it back on your insurance. That was deductible on your tax return. It is no longer deductible except or unless you fall in a FEMA declared disaster. So that tornado that hit St. Louis in May 15th, if you were part of that and you lost some piece of your home or something happened there and your insurance doesn't cover all of it, the piece that it doesn't cover is deductible. But unless you're part of that, if it just happened to you in the middle of a tornado flew by, and it hurt you, but it wasn't in a full FEMA area, unfortunately, this is not something that you can do anymore. That one is tough. It is also allowing the states to declare some of those disasters that you can deduct too. Okay, Jen? Okay, miscellaneous itemized deductions. Those were things like your tax return prep, something with your lawyer, the post office box, union dues. They literally were miscellaneous items. They were usually had to be more than 2% of your AGI, but a lot of folks sent in lots of little miscellaneous items. Those are done. They're terminated and you won't have those anymore. The only other one was educator expenses because they were able to use those as miscellaneous expenses, but now they're moved to a different spot. So they've been taken out of this listing and they are continued to be deductible. It was like a $250 per teacher because I'm sure teachers only spend $250 a year on, on all of their work things. But one of the things that I feel like we've lost with that, talking about unreimbursed expenses, was people's work unreimbursed expenses. There were times when folks had to do something for their job, and this was a way to get a little bit of a deduction for it, and that's gone. Same way with moving expenses, they've terminated that deduction. They did make it pretty hard to get that deduction for a while anyway, and now it's gone. Military is still, they do have a deduction for the military. And I think I have trivia because after that bad stuff, I thought we would throw some silly trivia back in. So I thought this was cute. The dot above your J or the I is called a tittle. And when you cross the T, that's called a jot. So you're going to tittle your I's and jot your T's is what you should be saying. And I'm going to use that forever now. I like that one. Okay, Jen. This one I know that you've probably heard of. People talk about it. This is your state and local tax cap increase. Since the TCJA, that was $10,000. So state and local includes income tax that's withheld on your wages, or the amount that you still owe to the state at the end of the year. It includes real estate, your real estate tax and your personal property tax. Sales tax you can use in lieu of them, but it's not included. It's an either or. You can either do sales tax or you can do the other income tax. Okay. It has moved to $40,000 for 25 and 26. Then for each year, or I'm sorry, $40,000 for 2025. Then for 26 through 29, there's a 1% increase each year. 2026, they put into the law the 40,004, which is a 1% increase, but then it continues to do that to 2029. In 2030, it reverts back to 10,000 if that happens in 2030. There is a phase out on this one. So for folks, and I believe this is married filing joint that make over 500,000, between 500,000, it starts to phase, and by a $600,000 of AGI, you no longer, you go back to $10,000. So to 2026, that piece goes up 1%, up, again, through the 2029, each year they go up a 1% increase for that phase out as well. But by the end of that phase out, if someone does make $600,000, they're back to $10,000 SALT. So that doesn't go below that, but the 40,000 isn't available to the highest net worth earners. Okay. Child tax credits, those went up. So the permanent increase is now $2,200 per child, adjusted annually for inflation. And that's good too, because it was like $500 per child for a really long time. So the fact that they've started instituting adjusted for inflation is really helpful. So if someone has a child and they have this $2,200 per child for this year, $1,700 of it will be refundable. That's capped for 2025, but it'll be adjusted as well annually for inflation. So what that means is if you got this $2,200 credit and you owed $500 in tax, it would apply $500 first, and then you would still get $1,700 check back. Okay. If you owed $300 in tax, they'd apply it, but you'd still only get $1,700 back as the refund. There's a phase out threshold again. It's $200,000 for individuals, $400,000 for married filing joint. There's also a $500 non-refundable credit for non-child dependents. And I think that is a really good one too. people are used to saying, well, is your kid in college, or you have a child, or what makes a dependent? And there's a lot of folks that have other people living with them that are technically dependents, but they're not an under 18-year-old child or a kid in college. They've got parents, they've got other children that are older, and they still now, if they can't claim themselves or someone else cannot claim them as a dependent, there is a $500 credit for them. Okay. Car loan interest deduction. So this one is a good one, and this one's new, and people haven't really had this in the before. And what this one does is up to $10,000 for a car that you have bought between 2025 and 2028. It's new car loan.
Now for Alex Carson.
So they must be what's called a passenger vehicle. So, but what they call a passenger vehicle is a car, a minivan, SUV, pickup truck, motorcycle, anything that's under 14,000 pounds. And it's manufactured primarily for use on public roads. So basically not commercial vehicles, but they can be really, really big because when we work on other sort of cars and we care about how big a car is for a business for depreciation, we say it has to be a gross vehicle weight over 6,000 pounds, and those are usually pretty big. So 14,000 is mammoth. But it's still, and it has to be manufactured for public roads. So a golf cart doesn't fall under this, but a motorcycle does. And it is to up to $10,000. And the final assembly of the vehicle has to be completed in the US. So if you have an Audi or a BMW or something like that, but it was finished in one of the many, many US factories for foreign cars, then it would fall under this. So it doesn't have to be a fully foreign US company maker. The car just has to have been assembled, or the assembly has to be completed in the US.
Is this currently in effect or will it go in effect in 2026?
It's 2025, so 2025 to 2028. I'll be honest, we're not really sure. You're allowed, it'll be a deduction. We haven't seen if it's going to show up it doesn't say it's itemized. It says it's just a deduction. So I expect to see it on the front page of the return or in one of those subsections that happen. But I'm not sure how we would even get the information. The interest, the lenders are supposed to have a special line item for you like you would for your mortgage interest. But this came up mid-year, and that's pretty hard. So they're kind of giving them a pass this year. I think if you're going to deduct it, you'll probably need to pull the information down from, the website or from your last statement or something for that deduction. Going forward, they're supposed to issue a form that tells you what you can deduct, what that is. But like I said, I think that it's a pretty hard turnaround for large financial institutions like that to be able to kick out those forms. One, I haven't seen the form, and then the government was shut down. So the IRS is a little bit behind as well. Okay. Okay. Silly trivia 3. I can't even pronounce that. Hippopotamonstrous equipdaliophobia. That's the fear of long words. So I thought that was almost cruel. Anyway, go ahead, Jen. Okay, this was a big one that everybody talked about. This is no tax on tips. And no tax on tips, it's up to $25,000 benefit per taxpayer. And what that means is it's per individual. So if you are two married people, you both earn tips, each of you could get a $25,000 benefit. If only one of you earns tips, it's how much that person, Bye, Karen. So much. Each of those folks, however you earn. So you don't get, so if you earn $45,000 in tips, it's still held to $25,000 of the tip income because it's only one person. Okay. It's available for only certain occupations. So the occupation was supposed to be published by October 2nd, 2025. I didn't see it come out, possibly because of the shutdown. So we'll have to wait and see what that is. They called it typical ones. So that's the ones that you're going to say are, the hair, the hairstylist, servers at restaurants, ones that you're accustomed to tipping, ones that are used to that. I cannot suddenly pay my staff via tips. And they just, so that people could eliminate $25,000. It has to be ones that were typical before December 31st of 2024. So before a year before this even passed. If you were a typical person that got tips, then now you're probably somebody that would fall under this. This excludes highly compensated employees. And the reason why I put that in quotes is because what it really means here, it's highly compensated employees does not mean somebody that just made a lot of money. It's what falls under retirement plan, highly compensated employees. So what that means generally is owners of companies, their family. It is ones that fall under sort of the ERISA thought, which is what does your 401k or, that. So highly compensated employee is a very specific group. And I think what that means is, yeah, those folks that own the place shouldn't be getting these tips. Most of the time, that's how it works anyway. The owner of a salon tends to not accept tips. I mean, I think it does sort of tend to fall under what is accepted and what is generally accepted, so that's what they've kind of put into this as law as to what was pretty typical. It doesn't work for those working for what's called a specified service trade or business. That's me, that's lawyers. It's particular ones that have a high dollar skill. Though skill set typically is what that is. And it phases out for that modified gross adjusted income again for $150,000 for single people, $300,000 for married filing joint. So that again is that modified. So if there's a piece that you have that's generally not taxable, interest isn't taxable, some other things like that, you have to add it back before you see if you phase out. They're going to have to file the employers have to file informational returns. This one I think is a little bit easier than this car thing because a lot of companies already track tip, especially restaurants. They already track, or at least a percentage, or they try to figure out what could be tips. So they should be filing informational returns to the recipients of the tips. And then also to the IRS, there'll be a separate one. So they'll try to do a matching. I think what the IRS will do is say if it's way above this, then why do you suddenly have this tip income? I think is probably, so I think it's probably a conservative way of doing it. I don't know if I love it because some folks, especially like I give, you might do a tip through the receipt, but some people hand cash. And I think that they're probably still going to just probably not present that as non-taxable, because if they hadn't included it in the past. This one is also supposed to expire in 2028. Next. Okay, and no tax on overtime. This was another big one. Now, unlike the one I just said, where I said, hey, it's 25,000 for each person, this one has a $12,500 deduction, $25,000 for joint filers. So it's not tied to the person, it's tied to the filing. So if you have two people and they each have overtime, you can take off $12,500 per person. But say you have a married couple and only one of them has $25,000 of overtime, they still get to deduct it, the full 25,000. So unlike that tip that was tied to each individual person, this one could be just one person has the whole 25,000 and that's okay. Okay? This again excludes that highly compensated employee, same quotes because it's this, they're following the same law. Owners can't do it. Some others, that would fall under their family would fall under this highly compensated employee group. This also phases out. It's the same phase out. They kind of like this round number, I guess, this 150,000 for individuals, this 300,000 for joint filers. And again, there's supposed to be another information return that's supposed to be filed with this. I think this is probably the easiest one because even the tip we had this could be cash component, could be some, something else that's going on. This one, I mean, it's pretty clear that we're talking about overtime and companies are going to track overtime. If they're not tracking overtime, we have a whole different set of issues. But most companies, especially those that have folks that are in unions or anything else, they're already tracking the overtime. They're also tracking it if they're paying the way that they should be paying. They're tracking to prove it. So the W-2s are already, or the wage is already going to be there. There's just going to be, I assume, some extra line item that says this piece is overtime. But again, I haven't seen the new forms. There is a transitional period for all of these. So we may not have any really good forms at all this year. They may not, do well for us. Although I would hope that they would, but they may not because they've asked for these forms to come out, but they didn't give necessarily specific advice what the form should be. They left it up to the IRS, which has been essentially shut down for, a month and a half. And I think that it causes some issues. So I think that the forms, I think somehow you're going to get this, but it's going to be in an odd place and maybe it'll be late. And I wouldn't be shocked if they said the W-2s that are typically January 31st might have an extended period to February 28th, or those that have overtime have the ability to extend to a certain period. I haven't heard that. I haven't heard rumbles. I'm just talking out loud, but I wouldn't be surprised to see something like that happen. Okay. And the exemptions have been extended. So for 1 year, I'm excited because I never know what on earth the exemptions are. I'm always like, I don't know. It's like third something million, somewhere around 14. For 2026, we finally have 15 and 30, and then it blows up again after that. So for 1 year, I have a good amount. But for 2025, what it is now is individuals are 13.99 million. Married couple is 27.98 million. And then it gets indexed for inflation for 2026. And I am thankful for that too, because what it was they always had to fight this to find out, to move it at all had to be a big fight. So this at least gets indexed for inflation. And what do these pieces mean? There's two parts to estate and gift tax. And the first is that, and let's do it backwards. The first is your gift. So you have the ability to gift in 2025 any individual $19,000 without telling anybody, and it just gets out of your estate. Okay. Married couples then can gift 38,000, meaning I gift and you gift to someone. One example that I use that I have actually had on multiple occasions where I've had I've had a couple come in and say, we're going to help our son or our daughter buy a home. We're going to help with this down payment, or we're going to buy the home. We're going to do something for them. And is there a way we can do this with the exemption? And sure, you and your husband give your son 38,000, you and your husband give your daughter-in-law 38,000, and you've given 76,000 on December 31st. You do it again on January 1st if you want to do that much, and you've given them $152,000 in yeah, I agree. I'm talking about other people's parents that aren't me. But but you can gift that much to your children or to whoever moves it out of an estate, and you haven't had to do anything. You've just written the checks. And when people do something like that, they can do that all the way down. That's how people gift to their grandkids, or they want to do something. It's a good way to think over time of moving things out of an estate if you have if you have a large estate. And one of the other things though, if you gift more, I'm going to write a check to my son for the 152,000 because it's July and the house is happening now. You just have to all you do is file a gift tax return and say you did. There's no tax involved. It's just a disclosure that you've moved it out of your estate because you have up to these 13.99 million of gifting without having any kind of estate tax for anyone. So if you don't gift to anyone, and you die with less than 13.99 million, there will not be an estate tax at all. That will not happen to you. It's the dollar above it that's taxed as an estate tax. So I wanted to make sure that everyone understands that because I know it gets clear, like that you kind of know that it's 19,000. Maybe you've heard that. Maybe I can gift up to that, but you don't even know what it means beyond that. You can gift more than that. You can, it's just that you have an exemption for your lifetime of almost 14 million. And it's going to be now indexed for inflation. So it'll be higher than that. 13.99 at this point is the least it's going to be. 27.98 million for a married couple is the least it's going to be. Then it's going to jump to 15 and 30 million in 2026. So if you die and both people die and they have less than 30 million, there is no estate tax issue. They're just fine. If you're at 32 million, say in estate, and you're just trying to find ways to gift, you can just gift enough to get below 30 million. So, you move things into trusts or you do something else. And so there's ways to just do some tax planning if there isn't a state that's that large. But just as an explanation, I know that people talk about it, but they don't really realize what it is. It's a lot of your estate has to be really big, truly, before we even care. So you can gift all over the place to everyone. And if you say, and sometimes you don't think about it, but one spouse may pass away and there could be life insurance. So the second spouse could have several million, say, of life insurance proceeds. As long as it's still under that single person's 13.99 million, you're fine. Okay. You can go ahead and move. Thank you. And then I thought I'd talk about charitable donations because this is another thing they did. There's one more up. There's one before that one, Jen, I think. The one that says yeah, that one. This one I'm not thrilled with. So, we'll see. For itemizers, there has been a ceiling of 60% of your AGI, and that we've had for a while. So I have income, my AGI is 150,000, and I give 10 grand to charity or 2 grand to charity or something. Fine, that's just an itemized deduction if you itemize, and it's fine. If I have income of 30,000, and for whatever reason, and maybe it's just because 1 year, maybe you're retired, you have funds set aside somewhere, you want to be particularly charitable that year. Your income is low because you don't really need quote unquote income. You've got cash. So your income is 30,000 and you give 27 or 20,000 or whatever to various charities. It's held at 60%. So on that 30,000, only 18,000 would be deductible as an itemized deduction. It carries forward into another year, but that's really the only time you run into it. Or if there's a business owner and you had given, but then maybe there's a business loss. Maybe you bought some machinery or equipment and there was a big, so you were able to take some, utilize some big deductions and you wanted that business loss. But so what, or, some sort of non-cash type thing that happened and you have this business loss now, you're going to be held on the charitable donation when you go through here. What I don't love is this floor. I don't like a floor to any charitable. And what that means is a 0.5% of your AGI is not deductible right off the bat. So that if you have a person that has, I'm going to do some math here for you really quick. Sorry. Times 0.05. Yeah. So if you have $100,000 of AGI and you give $2,000 to charity, the first $500 is not deductible at all. You just lose that. And I don't love that. And I don't think charities are going to love that, but that's where we are. Then there's on the other side, and I think that's what this is paying for. On the other side, if you don't itemize, you're one of those people, you're married, you're over 65, you've got like $35,000 already of standard deduction, but you still give some charity, you can deduct $2,000 above and beyond. So you don't have to itemize your deductions and you can still claim $2,000 of charitable deductions. So I think they took from one and gave to the other, is the reason why they did it this way. And for single filers, you can do that with 1,000. So if you've got that $15,500 standard deduction, but you gave to botanical gardens or the zoo, and you've got another $1,000 as a single filer, you can deduct that too, above and beyond. So I don't love it. I don't love a floor on anything like that, but I do like the non-itemizers being able to, because I think those that I think they were with the standard deduction going so high. That was the argument from charities back when that standard deduction became big, was like, you don't have any impetus to give at this point now. And who we really want is the little ones that might give to, the kettle, in December, and they give the $40 and the $50 ones and the $100 ones. Those matter. The ones that give the huge amounts will still do that because they'll find a way to make it deductible, or, they're over thresholds. But those that give those little amounts, we don't want to lose. And I think that that's what this is for. And then I think one more. Those were cash, by the way, donations, non-cash, same situation. So yeah. Or I'm sorry, they're 50% of AGI. The cash donations were 50, non-cash, to public charities. So the non-cash is only 30%. That's your goodwill donations, maybe stock donations, that kind of thing. And you can give to private foundations. And that's really what that is for either a private foundation for maybe a group that you belong to, but people also have family foundations. And I think this was to say to give directly to public charities instead of to your family foundation, if you wanted to get a deduction for it. Otherwise, if you wanted to set it up for your family foundation, you'll just get slightly less of a deduction. And that was just I think that was the thought process. And then I have one last silly trivia, and that is that humans and giraffes have the same number of neck bones. They do. The giraffe's neck bones are just a little bit bigger. Does anybody have any questions? I know I covered a whole lot. Like I said, you got the slide deck is yours. And if you have any other questions or anything that you want, feel free to shoot them over to me. I help in any way I can, or if there is anything that goes through the conversation that Jen can shoot to me. If somebody comes to you, Jen, feel free to send them my way. The firm can answer as best as we can for you.
Awesome. Thank you so much. This is an incredible presentation. Does anybody have any questions at all? I know we have 2 minutes left.
No, this is great. Thank you.
Yeah, very powerful.
Good. I know it's a lot, but it was a lot. I mean, there
I
really
was
was a lot of stuff there.
screenshotting and texting my mom because she qualifies as a senior, and my cousin because she owns a dog grooming company. So I was like, oh, this is incredible. This
Well,
was
and it
great.
really helps to know what to track now with all these changes, so I'm not tracking stuff that's no longer deductible and I'm paying attention to the right things.
That's important.
And in terms of charitable donations, I mean, at one point it was $300 and I had already exceeded it. And so it really kind of helps me think about what do I want to do with my money, and also, take care of myself too, not overgive.
Yeah.
Wonderful.
If I do occasionally I have other talks that I do for business owners and other things, and I can let you know, Jen, if anybody ever.
I would love that because that was
Yeah.
that was also a request for the 2026 calendar year. So yeah, I would love that.
Sure.
Do you meet with individuals outside of doing their tax returns to do tax planning sessions?
We do. You can certainly call, and probably Taylor Lukemeyer, our tax director, is probably the one that you would speak with then. I usually do the bigger speaking unless it's one of our clients. We do tax planning with our clients separately. But yeah, we can certainly talk you through anything. And if you have a question, Joni, anytime you can shoot it over. And
Yeah,
that we
I'm
can certainly
asking
answer
with
for you.
Couple of reasons. I'm working part-time with a firm and doing wealth management.
Mhm.
They had a couple of people that they, were talking with for estate planning and for tax returns. And I wanted to broaden the list of folks out that we were able to refer our clients to, just
Yeah.
for a variety of reasons, and let them choose. And so just kind of trying to build up more of a full service referrals of what we can do here. So
Yeah.
that's helpful.
Well, and when you're looking at something like that and somebody's interested, but they just don't know what we do put our time in. We look at a prior return, and we really will do the tax planning around that for you in a first meeting before you even decide if you wanted to hire. So if that was something where you were wanting somebody to look through, we certainly can do that too.
Awesome.
Thank you.
Cool.
I'm glad I could help anybody. If you need
This was
anything, let me
great.
know.
Thank you so much. I
Yeah,
appreciate
absolutely.
you sending me the slide deck, and I'll make sure to pass that on. So thank you guys.
Thank you.
Okay. Thank you, ladies.
Bye.
Thank you.
Bye.
See you all.